So that's Dabur for you. And the last quarter numbers actually were also a market mover, stock mover in that sense. Let's see what they report this time around. Mayuresh Joshi is head equity research at William O'Neill. He's joining us now to take some questions. There's 19 minutes to go for close. Mayuresh, good to have you with us here. Thank you very much for your time. The numbers are coming through and they're coming in very strong. I mean, at least from names like MRF, etc., which just reported. The revenues are largely in line, there's 10% growth, but gross margins, EBITDA margins are through the roof. But it's also kind of a very cyclical kind of a business in that sense, right? From a margin point of view, some 500 basis point improvement quarter on quarter. Will it hold, not hold? I don't think anyone knows, not even the management knows. We'll ask them if they do join us. What's your sense? What's the way to approach these stocks? Not just MRF, but C8, JK Tyres and others.
Afternoon, Prashant. No, you're absolutely right. And I think the input cost deflation which has taken place has clearly affected EBITDA margins quite significantly. So if you look at a large component of their input costs, natural rubber prices have come off, and the expectation largely is that it should hold somewhere around that 155, 160 rupee kg kind of range. Similar views in terms of carbon black, synthetic rubber, and therefore I think the input cost deflation has propped up margins for MRF and should prop up margins for most tire companies in general. In terms of the demand itself, I think the expectations both in terms of OEM demand expected to carry on in the next few quarters and the replacement markets holding up. I think that is a key in terms of the incremental volume growth that one really expects for tire companies to come through in FY24. If that probably happens to the extent of which the analysts are probably envisaging, you're probably expected to see huge operating leverage play out in their balance sheets. And therefore, I think tire companies probably stay in a sweet spot. Take a case in point in terms of the comparison check that we were doing at O'Neill. And if you probably look at Apollo Tyres, it's clearly come off and then breaking out above its key pivot levels. EPS rating a little bit on the lower side, but the expectation largely is that the TBR market, where it has a 31% share, the PV market, where it has a 21% share, input cost deflation to play out significantly here as well. But a large part of the expectation is that significant margin expansion over the next couple of years, maybe even 14.5 or 15%. And you stack that up with competitors like Balkrishna, which is expected to do well as well, subject to what the global conditions are. But it's definitely better than something like a JK Tyre at this point of time. And therefore, I think pushing through on its European operations very clearly, where it expects to gain around 10 to 12 million in terms of Russian tires not coming through. Apollo Tyres can also gain significantly in that part of the market where it has a 32% revenue contribution. Debt equity not to at 0.59. So yeah, tire spots in a sweet spot. Even Apollo, if they deliver on numbers, can continue doing.
By the way, MRF also has a 169 rupee dividend. That's what they've announced for this year. Yeah. So 169 rupees is the dividend announced by MRF. Something a lot of people watch out for and look out for. Yeah.
Absolutely, and would have a role to play in the excitement that surrounds the stock for sure. Interglobe Aviation, by the way, is still up about 4.5%. Mayuresh, hi, good afternoon. Surabhi here. Now, I don't know, aviation is a tough business to be in, right? We all know that. I'm just wondering what you've made of this whole situation and whether Interglobe at all makes the cut for you from an investment standpoint. I was looking at a longer term chart. I mean, if you trade the rallies, right, you make money in a stock like Interglobe. Otherwise, largely 2-3 years, we're talking about a 500 rupee sort of a band in which it keeps wavering. Your thoughts and whether you'd buy the stock or recommend the stock?
Oh, absolutely, Surabhi. I absolutely agree with you 100% on that. I think they become clear momentum cyclical plays when times are good for them. And at this juncture, what really happens in terms of the admittance to NCLT as far as the go-air management is concerned is going to be extremely critical. What you're also seeing in terms of the existing players in the market, obviously you've got Vistara in terms of a domestic airline along with Air India. SpiceJet has got a minimal kind of an operations at this point of time. But it's largely the resolution in terms of a fast mechanism that will probably determine the fortunes for this industry as a whole. Having said that, I think with the kind of development that's probably happened in terms of news flow, Indigo obviously benefits quite significantly because Go has a 8% kind of a market share, and obvious beneficiaries become Indigo and Air India in terms of lapping up that market share gain as well. The second element also in terms of crude prices coming off, which basically means that ATF prices come off quite significantly, aiding operating margins in terms of the overall efficiencies that airline companies probably run on. The third and the most important aspect, what does the government probably do if Go Air probably fails or is not able to deliver in terms of a resolution check over the next few weeks with the cancellations coming through and ticket prices going through the roof? Is there a cap that is probably coming on ticket prices? So as you rightly pointed out, I think a lot of ifs and buts for the industry as a whole over a longer period of time. I think they've not turned out to be companies where ROI has become consistent over longer time periods. And therefore, they become cyclical plays. On our own lens itself, I think it's crossed that key pivot level. So absolutely, I think the news flow in favor of Indigo, and it becomes a clear play, momentum cyclical play at this point.
Are you hearing, Mayuresh, this cap on airfares, or is just a risk? Because you're the second person telling us to watch out for this today.
So that might be an upside. That might be an upside risk question.
The market's still down about 50-60 points. Market breadth is also almost 1:1. You just go down the list with the stocks which are up with volumes, and it's absolutely tremendous once again, like yesterday. And by the way, the advanced decline may be 1:1, but the number of stocks which are up on volumes, I mean, that is far longer as compared to stocks on the downside. It's a shorter list. I mean, large volume-led losers as compared to large volume-led gainers once again. Mayuresh, I know you guys at William O'Neill do a lot of sort of quant and technical stuff as well. It's not possible to track everything because it's throwing up all kinds of names, bunch of stocks which move and then kind of something else comes on. But if you want to sort of trades or maybe take positions in some of these cash stocks, how do you do it? You just simply track momentum, maybe rate of change over say 3 months, 6 months or something. Broadly look at stocks which are stronger within that group, stuff which is not broken, 20-day, 50-day moving averages, and then sort of narrow down on names which you want to trade. Unless, of course, it's very bottom up and you really want to buy something for a specific reason, results related or fundamentals. Go on.
Oh, absolutely. I mean, apart from that, I think we've got a specific filters, Prashant, and we work entirely on our canceling methodology, where data sets are actually fed in, where we look at the earnings profile, which are automatically fed into the system. And the filtered lists come through our screeners as well. So I think it becomes a lot more easier in terms of shortlisting of candidates within individual sectors as well. Within the industry classification, as you pointed out, I think our group ranks itself and our sector rotation graphs on Panare, which is our institutional software, throws out which leading groups are probably expected to perform better in terms of the earnings pedigree and which leadership stocks are expected to come through. And therefore, I think this entire methodology works wonderfully well across market cycles. In this cycle, our own sense is that capital goods should continue doing a good show. Selective pockets within BFSI should continue doing exceedingly well. And some elements in terms of the broader markets, including power utilities and a few PSU entities, should continue delivering in terms of our core competencies.
Okay, all right. Mayuresh, I wanted to ask you about BEML land assets. I'm not sure whether you're tracking that or not. It recently listed. And, post-listing, it's fallen, I think, close to 35-40%. But the point is, tomorrow it comes out of T2T. So from a 5% circuit band, it will go to around a 20% circuit band. Any view on these assets? Because, some notes were indicating that it's worth much more, but the street, at least till now, didn't think so. Your view on it?
Afternoon, Nigel. No, absolutely. I think if you probably look at the composition in terms of their asset diversification, and you probably look at the expectations in terms of how these assets might be valued over the next couple of years, I think the expectations in terms of both an accounting norm at this point of time and expecting the standalone performance continuing well, I think core asset valuation itself should be relatively higher. With the margin bands that are definitely changing, I think you should see a lot more action happening onto that stock. And even the core operations, as I just pointed out, I think the government capex, which is improving every passing quarter as we speak. Next year is general elections around this same time. I think the accelerated capex, which will come through over the next 2 to 3 quarters, is definitely going to push through orders for a lot of PSU entities, BEML included in that. And in fact, on the asset value, which is far higher, as I said, even the standalone operations should continue delivering well, along with very, very strong performance as far as the dividends are concerned. So yeah, I think there is definitely a potential upside once the margin band changes.
Mayuresh, any thoughts on Havells? Not a bad set of numbers. The street was anticipating that the weakness in the environment may slow down their revenues. Consensus was baking in an 8% top line growth. The company's delivered close to 10%. Any thoughts on Havells? And considering the valuations are 40-45 times forward multiple, how do you like Havells? And is there any read-through from Havells numbers for the rest of the sector?
So large element, afternoon Grievance. So I think a large element in terms of the switchgear business actually doing well. I was just going through that press release. Has been a relatively robust and a resilience performance as far as that segment of Havells is concerned. The Lloyd's part of the business is more or less on a flattish note at this point of time. Management does expect it to start delivering at some point in the second half of this financial year. The electrical segment was always expected to be a little bit weak. The previous quarters hit in terms of input cost inflation, specifically copper prices. But I think they're increasing their dealer network significantly over the past few years. The non-South component has started going up as well. And therefore, I think the overall numbers seem to be reasonable. However, the management sounds a tad bit cautious in terms of their press release, in terms of the durable volume growth going forward as well. And therefore, I think con call is going to be extremely critical on how Q1 probably plays out and pans out and how the second half probably gets delivered. On the O'Neill lens, below pivot levels at this point of time, and therefore we closely watch out for management commentaries and some price strength in the stock will probably come.
All right, got that, Mayuresh. Well, is beginning to wind down the day. One trend that's stood out right from the morning is that consumer stocks have had a fairly decent run. Lever, for instance, is ending things on a high note, 1.5% up. Asian Paints, ITC, Britannia, quite a few of these stocks on the green side of the screen. Mayuresh, of course, we'll know more details on Titan's numbers in a bit from now. But leave us with your top consumer pick.
So global focus list will be Nestle is something that we've just recently added on our global list. Numbers have been pretty robust at this point of time. Milk inflation obviously remains a concern, specifically on the chocolates and confectionery business. But I think I was reading through a lot of management notes in terms of a lot of South-based milk producing companies. And their expectation is post-June, July. I think prices should start cooling off quite significantly, which means second quarter onwards, even this element of the market risk factor on milk inflation should start cooling off, which should support margins going forward. Volume growth has been very, very robust, and the expectations in terms of strong cash flows would continue in strong ROE delivery as well. So top pick from this space till now, as numbers have been announced, seems to be Nestle in our case.
All right, Mayuresh, thanks very much. Good speaking with you. And thank you very much for joining us as always here on Closing Bell. Thank you.